and welcome to our special coverage of the Reserve Bank of India's monetary policy that is set to be announced in just a few minutes from now at 10 o'clock. And we're coming to you live from the Reserve Bank of India headquarters in Mumbai. Let's quickly first get you started with what the street is expecting as per the 2018 poll. To begin with, this is going to be a status quo policy when it comes to the repo rates as well as the stance which the majority believe will be left unchanged. There's hardly a participants that told us that it's possible that RBI may prepare the markets for a shift in stance sometime in the future. So as far as the big, focus areas in this policy itself, the majority of our respondents said they're going to primarily watch out for what the RBI says on growth, where a large majority is expecting an upgrade, and also on inflation, if RBI expresses any concerns about the monsoons or the oil prices going up as well. Apart from this, we asked the respondents when they start to see the first rate cut from RBI, and the majority expects it only by October, with about 40% telling us that perhaps by August is when the Reserve Bank of India could start cutting rates, but no earlier than that. On liquidity as well, the market is going to watch out for any comments from the Reserve Bank of India governor that they will keep the liquidity comfortable. Remember, since the February policy, liquidity conditions have eased, and the RBI has been actively managing liquidity at both ends with multiple interventions in the market. So we expect the governor to signal that the RBI will continue to remain nimble with its operations and keep liquidity comfortable. As far as the inflation forecast is concerned for FY25, the is 4.5%, and a large majority expects that that will be left unchanged as far as this policy is concerned. But on growth, most of our respondents are expecting an upgrade from 7% for FY25 to 7.1 all the way to 7.5%. As far as the tone of the governor is concerned, absolutely even is what we've been hearing from our respondents, so we'll watch out for that. So largely, we're going into this policy expecting no rates changes, no stance change, some perhaps tinkering on the macro parameters, but anything that the governor says as far as the exchange traded currency derivative rules are concerned, or action on many financial entities, all of that is also going to be very closely watched in this policy. So with that, let me invite our guests as well who will be joining us with their expectations. We have Kaushik Das, who is the Chief Economist at Deutsche Bank with us, Lakshmi Iyer, the CEO, Investment and Strategy at Kotak Alternate Asset Managers. We have Indranil Pan, Bank, and Parul Mittal Sinha, the Head of Financial Markets India at Standard Chartered Bank. Okay, we have, Lata also joining us all the way from Chicago. It's a late, and Ekta, of course, joining in from the studio to help us take this discussion forward. Lata, let me quickly come to you. What surprise could the RBI really throw? We're going with a business as usual policy into this.
Oh, well, that's how it looks like. And when there is an election in the backdrop, it is unlikely that the Reserve Bank will want any fireworks. So it may keep it, as you said, as toned as possible. That's my expectation. The only surprise will be on growth. Will they go all the way to that 7.4%, which they have published in the they have a dynamic stochastic general equilibrium model, which forecasts that the year that just ended, the fourth quarter, is likely to be much higher than the residual 5.9%, which the NSO figures indicate. They believe that it will be much higher. So last year's growth can be, close to 8%, but Reserve Bank normally doesn't speak about the year that was. So we won't get anything for FY24, but FY25, will they go all the way to a 7.4? If they do that, that can be a big shot in the arm. And that's precisely what the Reserve Bank may not want. I mean, we don't have too much of goods inflation. They may not want asset inflation in the form of a market rally. So chances are that they may, kind of hold back from going all the way to 7.4% is my guess. Otherwise, there are no surprises. On liquidity, they will have to say something about the money that's coming in or will start coming in because of the bond index inclusion. But they still have the June policy to speak about that. So they may not say much about liquidity either. That's my best guess. But maybe we want to ask the experts. Kaushik, your first guess. Do you expect that there is a growth upgrade?
Yeah, Lata, I think there will be a growth upgrade because it seems that FY24, the growth could be higher than 7.6, what CSO has indicated. If that goes close to 7.9 or 8, then RBI may be willing to increase their growth forecast from 7 to 7.4, as you indicated in the monthly bulletin that came out. So I'm mentally prepared that growth forecast would be raised upward. It will be, in fact, a surprise if they don't. On inflation, I think 4.5% they'll maintain. There could be some tweaks on the quarterly forecast, but overall, I don't see 4.5 changing. I think one possible, surprise that can come, and I'm saying this purely because the last two April policies, RBI has surprised whatever the consensus was, that whether there could be a change of stance in this policy. Remember that if you change the stance to neutral, doesn't mean that RBI needs to cut in the next policy. It means you can hike, you can pause, and you can cut, but it gives RBI some bit of flexibility and to guide the market or prepare the market for an eventual easing, and that could be 2-3 policies later. So, April is the policy where we have seen surprises in the last 2 years. So I'll not be entirely surprised if suddenly the stance is changed to neutral.
Okay. Well, let me toss then the same thing to Parul. Parul, dovish, hawkish, neutral, how will this sound?
So we think RBI will do a good job as usual of being very balanced. There is enough to be cautious about. There's enough to cheer about. So they will do a tight walk like they usually do, and they do a good job of it. So the core inflation is low. Consumption demand driven dynamics in the country are very contained. On the other hand, growth is robust. So they can talk about both aspects. What we will watch out for is, are they talking about more upside risks to inflation, or are they talking about how inflation is well contained and the room for positive monetary policy conduct? There are geopolitical risks that have come to the table. If those were not there, so if oil wasn't trading at 90 and above, we would be very positive and we would expect RBI to be able to sound dovish. I think once those risks are behind us, maybe in 2 to 3 months, we do expect RBI to exercise the room they have to sound more dovish.
Okay, all right. Well, as of now, we are just about going flat into policy. We have the Nifty, which is just about lower by around 27 odd points. The Bank Nifty, which is just about higher by around 55 odd points, so just about consolidating at this point in time. It's a good outcome despite the weakness that we've seen in Asia as well as the US markets overnight. Indranil, wanted your thoughts just a couple of minutes before we hear the RBI speak for the first time in FY25. What's your sense, given that, Brent crude is now at $90 per barrel and has risen around 10+% since the last policy?
I think Parul has robbed my thought process anyways, in the sense that I think my understanding is that they will possibly sort of tinker with the wording in terms of how they look at inflation. It was only food till now, but now we have all commodity sets going higher. Now, while crude may not have a direct implication in terms of the headline CPI, because the government is controlling the pump head prices and have also reduced it, but it can have an indirect effect in terms of the pass-through. Commodity prices are on the side, so that's something to look into in terms of how it has its effect on the headline numbers. Currency is weaker than what we were estimating and understanding to be as we stepped into the new financial year. The last but not the least is edible oil prices are also on the higher side. Now, if you remember last year, the government had controlled edible oil prices, the India impact of the larger edible oil prices globally by cutting customs. Now they do not have that room. And if crude remains on the higher side, we find a close correlation between edible oil prices and crude prices. So that's something also to watch out for in terms of how the overall inflation trajectory pans out. So I think no room to do anything much. In my opinion, no room also to change the stance. Because if they change the stance the way markets are poised at this point in time, they will immediately read it as dovish, and that might not be a very good consequence for most of the other market parameters that we look at. So they will possibly not change the stance, and even in the last MPC policy, they have clearly highlighted that there is no judicious forward-looking guidance that can be put out in the current atmosphere, and I think the thought process will remain the same.
Lakshmi, a quick word from you. We're about to hear from the governor in just a few minutes, so no room or reason really for a change in rates or stance. A quick word on liquidity as well. You know, given that government spend is only expected to again pick up in a couple of months, and this bond inclusion starting June onwards, the kind of inflows that will come in, what do you expect the governor to say on liquidity for the markets?
So, so far they've been managing the liquidity pretty deftly, from a pseudo tightening sort of a mode. They've done some sort of a pseudo easing again and got the, the overnight rates very close to where the repo rates are. So I think that oscillation is something which the markets are pretty comfortable with, though we are in a tight liquidity regime as of now. But as you rightly pointed out, over the next quarter probably is when the actual flows will start trickling in, though we've already started seeing glimpses of that. So I think some continuity on that front. Earlier, the markets were expecting some OMOs, I think, but that doesn't seem to be a big concern at this point in time. So I think without any major tweaks, either on the language or on the overall front, I think markets will look out for stability, because at this juncture, no one is really expecting any, I would say, significant nudges from the RBI MPC. And I would say that that's true for either asset classes. So I think pretty much status quo on all grounds. And yeah, as Parul rightly alluded to, probably if things were relatively easier from a crude oil perspective or from oil perspective, then the leeway to be a slightly more liberal in terms of your words probably could have been there, which may not be the case as of today.
Okay, point, Lakshmi. There we have to remember that the last policy got hijacked by the Paytm issue. At the moment, non-monetary policy issues are there, which are kind of warning the market, not unsettling by any means. A couple of NBFCs have been told to withdraw from some of their activities, IIFL and JM Financial. Likewise, we have seen this currency derivatives, the Reserve Bank asking for brokers to check. I mean, they've not exactly told the brokers to check whether the underlying exposure is there, but the fact that they have reiterated that an underlying is needed for currency derivatives is something that the market will watch out for. So these non-monetary policy issues are also going to take away some of the bandwidth. One really wants to know whether the Reserve Bank is worried about the aggressive, the very good growth in the stock market and in growth per se, because that basically tends to mean a wealth effect, higher consumption, and therefore the likelihood of pushing up inflation. So all those dots could be connected. We will have to see whether the Reserve Bank will connect them. Ritu, I think we have just a minute to go. Last thoughts before we get in?
Yes, I mean, like you said, non-policy measures always the focus in the press conference, especially given that, this is a no-action policy, so to speak. Also, just a word to our viewers, the monetary policy report, the MPR report, will also be released, in this policy. So we will get some futuristic projections on both inflation and growth and the assumptions. Position. So that's also another thing that we are going to be watching out for. For the time being, it's almost 10 o'clock, so we will be hearing from the Reserve Bank of India governor shortly. All of the participants, are not really expecting any move, but I'll toss it back to my anchor Ekta in the studio for her comments.
Thanks, Ritu, for that. So we're still waiting to hear from the governor, and I think he's there. We can cut across.
First monetary policy statement of the current financial year 2024-25, and this is how it goes. As you would be aware, earlier this week we commemorated the 90th year of the Reserve Bank of India. The journey of this august institution is closely related to the evolution of the Indian economy. Numerous historic events have occurred during these 9 decades. And they consist of the nationalization of the Reserve Bank in 1949, the planning era, bank nationalization, wars, droughts, the fall of the Bretton Woods system, oil shocks, a precarious balance of payment situation and the subsequent market reforms, the Asian and the global financial crisis, the taper tantrum, and finally the COVID-19 pandemic and the geopolitical hostilities of the recent years. During this journey, the Reserve Bank was always at the forefront, combining its developmental and regulatory roles in steering the Indian financial system and the economy towards stability. While doing so, the Reserve Bank has discharged its responsibility with integrity and professionalism. Compared to many other central banks, the Reserve Bank has a much broader range of functions which is vital for ensuring macro-financial stability of a modern and complex economy like functional complementarities among the various responsibilities of the Reserve Bank of India. Being a full-service central bank, the Reserve Bank is well positioned to take a holistic view of various critical issues confronting the economy and the financial sector, and it's also well positioned to take appropriate steps in the best interest of the economy. We continuously strive to learn, adapt, and innovate while performing our multiple responsibilities. I would now like to focus on the decisions and deliberations of the Monetary Policy Committee meeting, which met on 3rd, 4th, and today, 5th of April. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Reserve Bank MPC decided by a majority of 5-1 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF, rate remains at 6.25%, and the marginal standing facility, that is the MSF rate, remains at MSF rate and the bank rate, they remain at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, the growth inflation dynamics have played out favorably. Growth has continued to sustain its momentum, surpassing all projections. Headline inflation has eased to 5.1% during both January and February. And this has come down to 5.1% in these 2 months from the earlier peak of 5.7% in the month of December. Core inflation has also declined steadily over the past 9 months to its lowest level in the series. The fuel component of CPI remained in deflation for 6 consecutive months. Food inflation pressures, however, accentuated in February. Looking ahead, robust growth prospects provide the policy space to remain focused on inflation and ensure its descent to the target of 4%. As the uncertainties in food prices continue to pose challenges, the MPC remains vigilant to the upside risks to inflation that may derail the path of disinflation. Under these circumstances, monetary policy must continue to be actively disinflationary to ensure anchoring of inflation expectations and fuller transmission of the past monetary policy actions. The MPC therefore decided to keep the policy rate unchanged at 6.5% in this meeting and also remain focused on withdrawal of accommodation. The commitment to aligning inflation to the target. I would now like to provide an assessment of growth and inflation and I will begin with the scenario relating to global growth. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Now, in my statement, whatever I am saying, it is backed up with a lot of data which are there in the footnotes. So those of you who are interested could refer to this statement, which as usual will be uploaded in the RBI website immediately after this statement is over. So a lot of data backing up whatever I am saying is available in the various footnotes of my statement. You may like to refer to it. Let me start again on the global growth part. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Global trade is expected to grow faster in 2024, although weaker than its historical average. Inflation is moving closer to targets, but the last mile of disinflation is turning out to be challenging. Services inflation in advanced economies remains sticky amidst tight labor markets. Accordingly, central banks are cautious in their communications, thereby tempering market expectations about the timing and magnitude of interest rate cuts later during this year. Equity markets have gained while bond yields and the US dollar have remained volatile. The overall outlook is challenged by continuing geopolitical conflicts, disruptions in trade routes, and high public debt burden. In the last monetary policy statement, if you recall, I had expressed concerns about the high levels of public debt in both advanced and emerging market economies, that is the EMEs. These are risks which could erupt abruptly. Debt to GDP ratio, which rose during the pandemic, remain elevated and are projected to increase further with rising interest and cost of borrowing, thus raising debt sustainability concerns. Worsening debt situation in advanced economies, in particular, can generate spillovers for the emerging market economies in the form of swings in capital flows and volatility in financial markets. The emerging market economies with rising levels of public debt in particular would be vulnerable to these spillover effects. Credible fiscal consolidation plans, particularly in major advanced economies, focusing on growth-enhancing investment, would be necessary to address this challenge, not only for themselves, but also, I think, for the overall global economy. India, however, presents picture on account of its fiscal consolidation and faster GDP growth. Turning to domestic growth, the domestic economic activity continues to expand at an accelerated pace, supported by fixed investment and improving global environment. The second advance estimates placed the real GDP growth at 7.6% for 2023-24. The third successive year of 7% or higher growth. From the supply side, industrial activity led by manufacturing continued its momentum. The Purchasing Managers Index, that is PMI for manufacturing, displayed a sustained expansion in both February and March, touching a 16-year high in the month of March. Services sector exhibited buoyancy with all sectors within the services sector registering strong growth. The PMI services remained above 60 during February and March, suggesting sustained healthy expansion. With rural demand, consumption is expected to support economic growth in 2024-25. Urban consumption stayed buoyant, as evident from various indicators. Details are given in the footnote. The resilience in cement production, together with strong growth in steel consumption and production and import of capital goods, augur well for the investment cycle to gain further traction. The total flow of resources to the commercial sector from banks and other sources at rupees 31.2 lakh crore. I repeat, at rupees 31.2 lakh crore during 2023-24, significantly higher than that of the previous year, which was 26.4 lakh crore. External demand in February, with exports registering double-digit expansion. Trade deficit, however, widened in February as imports also accelerated. Going forward, the outlook for agriculture and rural activity appears bright, with good Rabi wheat crop and improved prospects of Kharif crops due to expected normal southwest monsoon. Strengthening of rural demand, improving employment conditions and informal sector activity, moderating inflationary pressures, and sustained momentum in manufacturing sector should boost private consumption. Let me read this sentence again because there are quite a few points in this. Strengthening of rural demand, improving conditions and informal sector activity, moderating inflationary pressures, and sustained momentum in manufacturing and services sector should boost private consumption. As per our survey, consumer confidence 1 year ahead reached a new high. The prospects of investment activity remained bright owing to upturn in private capex cycle becoming steadily broad-based. Persisting let me just rephrase it. The prospects of investment activity remain bright owing to upturn in private capex cycle becoming steadily broad-based, persisting and robust government capital expenditure, healthy balance sheets of banks and corporates, and rising capacity utilization, and finally strengthening business optimism as reflected in our survey. The sentence is a bit long. It's better that I read it out again for greater clarity. And sorry about that, but I think it provides greater clarity. The prospects of investment activity remain bright owing to upturn in private capex cycle becoming steadily broad, persisting and robust government capital expenditure, healthy balance sheets of banks and corporates, rising capacity utilization, especially in the manufacturing sector, and strengthening business optimism as reflected in our survey. Improving global growth and trade prospects, coupled with our rising integration in global supply chains, are expected to propel external demand for goods and services. The headwinds from protracted geopolitical tensions and increasing disruptions in trade routes, however, pose risks to the overall outlook. Taking all these factors into consideration, the real GDP growth for the current financial year 2024-25, which started on 1st April, the real GDP growth for 24-25 is projected at 7%, with Q1 at 7.1%, Q2 at 6.9%, and both Q3 and Q4 at 7% each. The risks are evenly balanced. Turning to inflation, food price uncertainties continue to weigh on the inflation trajectory going forward. A record Rabi wheat production would help temper price pressures and replenish the buffer stocks. As you would recall, the buffer stocks had slightly dipped, but I think the record Rabi production of wheat is expected to replenish whatever depletion had taken place. Moreover, early indication of a normal monsoon augurs well for the Kharif season. International food prices also remain benign. The tight demand-supply situation in certain categories of pulses and the production outcomes of key vegetables warrant close monitoring, especially in the ground of the forecast of above normal temperatures in the coming months. And these above normal temperatures, as per the current forecast, are expected to prevail in April, May and June, and not beyond June. That is the current forecast. Frequent and overlapping adverse climate shocks pose upside risks to the outlook on international and domestic food prices. Cost push pressures faced by firms are seeing an upward bias after a period of sustained inflation. Deflation in fuel is likely to deepen in the near term, following the cut in LPG prices in the month of March. Notwithstanding in petrol and diesel prices in mid-March, the recent uptick in crude oil prices, especially in the recent few days, they need to be very closely monitored. Continuing geopolitical tensions also pose upside risk to commodity prices and supply chains. Assuming a normal monsoon next year, CPI inflation when I say normal monsoon for next year, I mean the current year 24-25. CPI inflation for the current year 24-25 is projected at 4.5%. I repeat, CPI inflation for the current year 24-25 is projected at 4.5%, with Q1 at 4.9%, Q2 at 3.8%, Q3 at 4.6%, and Q4 at 4.5%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have explained the growth situation, I have explained the inflation scenario. Synthesizing everything, what does it mean? What implications it has for monetary policy, and that is precisely what I would like to explain now. Inflation has come down significantly but remains above the 4% target. Food inflation continues to exhibit considerable volatility, which is impeding the ongoing disinflation process. High and persistent food inflation could unhinge anchoring of inflation expectations, which is underway. Our ongoing effort is to ensure fuller transmission of policy actions and anchoring of household inflation expectations. The strong growth, together with our GDP projections for 24-25, give us the policy space to unwaveringly focus on price stability. Now, 2 years ago, around this time, when CPI inflation had peaked at 7.8% in April 2022, the elephant in the room was inflation. The elephant has now gone out for a walk and appears to be returning to the forest. We would like the elephant to return to the forest and remain there on a durable basis. In other words, it is essential in the best interest of the economy that CPI inflation continues to moderate and aligns to the target on a durable basis. Till this is achieved, our task is unfinished. The success in the disinflation process so far should not prevent us from vulnerability of the inflation trajectory to the frequent incidence of supply-side shocks. Our effort is to ensure price stability on an enduring basis, paving the way for sustained period of high growth. I would now like to turn to the aspect of liquidity and financial market conditions. In the February monetary policy statement, if you recall, I mentioned that liquidity conditions were driven by exogenous factors which were likely to correct in the foreseeable future. Liquidity conditions eased during February and March in the wake of increased government spending, Reserve Bank's market operations, and the return leg of US dollar and Indian rupee sale by swap auction, which had been done earlier in 2022. In particular, liquidity situation improved with system liquidity turning intermittently surplus in the first half of the month. In these circumstances, the Reserve Bank conducted 14 fine-tuning rate repo operations, that is VRRR operations, during February and early March to absorb intermittent surplus liquidity. Anticipating the seasonal tightening of liquidity at end March, the Reserve Bank injected liquidity through rate, that is VRR operations, both main and fine-tuning operations. Consequently, the average borrowings under the MSF window moderated, Liquidity conditions have, however, again turned surplus from March 30th, necessitating VRR auctions from 2nd of April. So you would have noticed in the last 2-3 days, we have been conducting more than one VRR auctions. On 2nd April, then again we did it on 3rd April. So last 2 days we have been doing it. And today, as you know, there is a variable rate. There is a, what you call, as per our cycle, we are doing our operation for 14 days, a VRR operation for 14 days. Now, reflecting these liquidity developments, the weighted average call rate, that is WAC, exhibited a softening bias and has hovered near the repo rate in the last policy meeting. In tandem, rates in the collateralized segment of the call money market have also softened. Financial conditions remained conducive as reflected in reduced term spread in the GSEC market and stable risk premium in the bond market. In the credit market, monetary transmission continues to be work in progress. Looking ahead, the Reserve Bank will remain nimble and flexible in its liquidity management through both main and fine operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity to ensure that money market interest rates evolve in an orderly manner that preserves financial stability. The Indian rupee has remained largely range-bound as compared to both its emerging market peers and a few economies during the financial year 2023-24, that is till 31st March last. The Indian rupee was the most stable among major currencies during this period. This is very important. The Indian rupee was the most stable among major currencies during this period. As compared to previous 3 years, the Indian rupee exhibited lowest volatility in 2023-24. The relative stability of the Indian rupee, which I just mentioned, it reflects, I would emphasize, the relative stability of the Indian rupee reflects India's sound macroeconomic fundamentals, financial stability, and improvement in our external position. Turning to financial stability, let me say that latest data as at end December 2023 show that the key indicators of capital asset quality of commercial banks continued to be healthy. The financial indicators of non-banking financial companies, that is NBFCs, are also in line with that of the banking system as per the latest data available. Let me emphasize here that banks, NBFCs, and other financial entities must continue to give highest priority to quality of governance and adherence to regulatory guidelines. Financial sector players, by and large, to public money, be it of depositors in banks and select NBFCs or investors in bonds and other financial instruments. We should always be mindful of this aspect. The Reserve Bank will continue to constructively engage with financial entities in this regard. It needs to be recognized that financial stability is a joint responsibility of all stakeholders. The Reserve Bank has also been engaging with the regulated entities and various stakeholders for simplifying its regulations and reducing compliance burden. As part of this endeavor, the recommendations of the Regulations Review Authority, RRA 2.0, constituted by the Reserve Bank have been largely implemented. The RRA 2.0 has set a new benchmark for meaningful engagement between the regulator and the regulated entities. Moving further in the same direction, internal review groups within RBI were formed in 2023 to rationalize, simplify, and remove obsolete regulations and streamline the reporting mechanism. In pursuance of the recommendations of the RRA 2.0, that is the Regulations Review, was constituted by the RBI. So in pursuance of the recommendations of the RRA 2.0 and the internal review groups which we constituted in 2023, more than 1,000 circulars have been withdrawn. A master direction for rationalizing and harmonizing supervisory returns has also been issued. The Reserve Bank will continue to follow a consultative approach and undertake review of regulations in line with the evolving financial landscape. Turning to external sector, during the first 3 quarters of 23-24, India's current account deficit narrowed significantly on account of a moderation in merchandise trade deficit, coupled with robust growth in services exports and strong remittances. India's merchandise and services exports have grown at a healthy pace in the 4th quarter of 23-24. India is the largest recipient of remittances in the world. The cost of receiving remittances is gradually coming down. Overall, the current account deficit for 2024-25 is expected to remain at a level that is both viable and eminently manageable. On the external financing side, India's foreign portfolio investment, that is FPI flows, saw a significant turnaround in 23-24. Net FPI inflows stood at $1.6 billion during 23-24, as against net outflows in the preceding 2 years, which were in the order of 14.1 billion outflow in 21-22 and 4.8 billion outflow in 22-23. This is the second highest level of FPI inflow after 23-24. Direct investment moderated to $14.2 billion in April-January 23-24 from 25 billion a year ago. External commercial borrowings, that is ECBs, and non-resident deposits recorded higher net inflows compared to the previous year. The amount of ECB agreements also grew markedly in 2023-24 up to February 24. Now, all this data is given, details are given in the footnote. India's foreign exchange reserves reached an all-time high of $645.6 billion as of March 29, 2024. I repeat, India's foreign exchange reserves reached an all-time high of $645.6 billion as of March 29, 2024. Latest data on various external vulnerability indicators suggest improved resilience of India's external sector. We remain confident of meeting our external financing requirements comfortably. Now, talking about forex reserves, I recall that in 2021, our forex reserves had also reached 642 plus billion $. Then following the commencement of the war in Ukraine and the outflow of dollar from India as well as from several other countries on safe haven demand, there were signs that forex reserves of India was going down, and at one point it had gone down. Our forex reserves had gone down to about $524 billion. And at that time, I think several questions about, what was RBI doing, whether RBI was on the right track. If you recall, at that time, we had very clearly assured that the decline in reserves was partly due to, the change in valuations of assets, and also partly due to our intervention in the market to ensure an orderly depreciation of the rupee, which is a part of our policy, ensuring orderly depreciation or orderly appreciation. And we had that time very clearly and firmly stated that we are using our forex reserves in a very judicious manner. It was a strong umbrella which we had built up, and we are using it because it was raining heavily, and we were mindful of what we were doing. We knew what is our purpose and which direction we are moving. And as you would see, now the reserves have again risen, and they stand at an all-time high of $642.6 billion, 645.6 billion as of 29th March. So, this is one area on which the Reserve Bank remains committed. Number one, to sort of ensure that, the exchange rate of rupee is market determined. There are inflows and outflows of dollars happening. But it is our focus, it is our prime focus to build up a strong umbrella, a strong buffer in the form of a substantial quantum of forex reserves, which will help us when the cycle turns or when it rains heavily. So let me move forward. Sorry for that digression, but I thought it was necessary to set the record straight. I shall now announce certain additional measures. The first announcement relates to trading of sovereign green bonds in the International Financial Services Center, IFSC. With a view to facilitating wider non-resident participation in sovereign green bonds, a scheme for investment and trading in these bonds in the IFSC will be notified very shortly. The second announcement relates to the RBI Retail Direct Scheme and introduction of a mobile app to operate the RBI Retail Direct Scheme. The Reserve Bank Retail Direct Scheme was launched in November 2021 for enabling the retail investors to participate in the GSEC market, both in the primary as well as in the secondary market auctions and operations. It is now proposed to launch a mobile app for accessing the Retail Direct portal. This will be of great convenience to retail investors and deepen the GSEC market further. The next announcement relates to review of liquidity coverage ratio, that is LCR framework. Technological developments have enabled bank customers to instantly withdraw or transfer money from their bank accounts. While improving customer convenience, this has also created challenges for banks to deal with potential situations when, due to certain factors, a large number of depositors decide to instantly and simultaneously withdraw their money from the banks. The developments in certain advanced jurisdictions during the last year demonstrate the difficulties it can create for banks. The difficulties it can create for banks to deal with such situations when there is heavy outflow of, heavy outflow or transfer of deposits. And this happens only if that particular bank is in an acute stress. It's not a normal thing which happens, but then the banks will have to remain prepared for all eventualities. A need has therefore arisen to undertake a comprehensive review of the LCR framework for banks. A draft circular will be issued shortly for stakeholder consultation. Our approach is to have a balanced approach, and as I said a little while ago, we follow consultative approach, so therefore the draft circular will enable the stakeholders and the banks to give their views and opinions and suggestions, which will be taken into consideration by the Reserve Bank before arriving at a final decision. The next announcement relates to dealing in rupee interest rate derivative products for small finance banks. At present, small finance banks are permitted to use only interest rate futures for proprietary hedging. It has now been decided to allow small finance banks to use permissible rupee interest derivative products. This will allow further flexibility to small finance banks for hedging their interest rate risk and enhancing their resilience. The next announcement relates to enabling UPI for cash deposit facility. Deposit of cash through cash deposit machines, that is CDMs, is primarily being done through the use of debit cards. Given the experience gained from cardless cash withdrawal using UPI at the ATMs, it is now proposed to facilitate deposit of cash in CDMs, that is in the cash deposit machines, using UPI. This measure will further enhance customer convenience and make currency handling process at banks more efficient. And the next announcement relates to, I have two more announcements and I shall be quick. Next announcement relates to UPI access for prepaid instruments through third-party apps. At present, UPI payments from prepaid payment instruments, that is PPIs, can be made only by using the web or mobile app provided by the PPI issuer itself. It is now proposed to permit the use of third-party UPI apps for making UPI payments from these PPI wallets. That means the PPI wallet holders no longer have to be completely dependent on the PPI issuer, but they can use any other third-party app which is operating on the UPI. This will further enhance customer convenience and boost adoption of digital payments for small value transactions. And the final announcement relates to distribution of central bank digital currency, that is CBDC, the e-rupee, through non-bank payment system operators. The CBDC pilots are currently in operation with increasing number of use cases and participating banks. It is proposed to make CBDC retail accessible to a broader segment of users by enabling non-bank payment system operators to offer CBDC wallets. This will facilitate testing of resiliency of the CBDC platform to handle multi-channel transactions. Let me now conclude, and I would like to state that as we progress towards RBI at 100, the upcoming decade is going to be a transformational journey. The Reserve Bank will continue to focus on preserving financial stability and promoting a system that is robust, resilient, and future-ready. And it will be robust, resilient, and future-ready to support economic growth. Price stability will be a key component of this endeavor. Turning to the present, inflation is on a declining trajectory and GDP growth is buoyant. At this juncture, we should not lower our guard, but continue to work towards ensuring that inflation aligns durably and sustainably to the target. Our goal is in sight, and we must remain vigilant. We are inspired by the profound words of Mahatma Gandhi, and I quote, "One must persevere and have patience. Success is the inevitable result of such effort." Thank you. Namaskar.
Okay, so no change in rates, no change in stance as expected. I guess the only surprise was the growth forecast for FY25 not being tinkered. With that, let's quickly get you a summary of everything that the governor announced for this policy. The repo rate, of course, being left unchanged at 6.5% with a 5:1 vote. That is, one MPC member dissented on the repo rate action. The stance has been left unchanged as well. On the growth, you have a 7% projection being maintained for FY25, with the first quarter seen slightly lower now at 7.1% compared to 7.2 earlier. The second quarter at 6.9% growth versus 6.8 earlier. The third and the fourth quarter growth rate seen at 7%. On inflation, RBI said it is going to remain watchful of the developments around crude prices and also on the food inflation, which continues to play spoil sport, but core inflation is something they take comfort from. For FY25, the CPI projection unchanged at 4.5% for the first quarter. It has been marginally revised lower to 4.9% for the second quarter, again lower at 3.8%, maintained for the third quarter at 4.6%, and slightly lower again for the fourth quarter at 4.5%. Besides this, on liquidity, as the markets expected, the RBI said it is going to remain nimble with its operations, but nothing, to really prepare the markets for what happens when, the bond inflows start from June or when the government spending picks up. But RBI again saying it is going to remain nimble. Interesting comment on the inflation coming in, that 2 years ago this time the inflation had peaked at 7.8%. Now we're standing at a juncture where the elephant in the room, that was inflation, has taken a walk to the forest, and RBI hopes that it remains there. Apart from this, RBI reiterating that they have enough and more forex buffers, forex reserves at all-time highs to deal with any currency fluctuations. In terms of non-policy measures that were announced, there's a scheme for trading of sovereign green bonds at IFSC, which will be announced shortly. There is an undertaking of a comprehensive review of the LCR liquidity framework for banks, a draft circular for which will be issued shortly. Dealing in rupee interest rate derivative products will be allowed for all small finance banks. And then, of course, there are some, the usual announcements on UPI, some on CBDC as well. So that is the large takeaway. Status quo policy. Expected. The surprise was on growth not being revised upwards. Let me quickly toss it to Lata Venkatesh back there for her editor's take on what the governor said. Lata.
I guess this is the flattest policy I've ever heard. I mean, the only hope we were having of some drama would be if they would up the growth forecast, because it was already there in the bulletin. But, bulletin forecasts get the sanctity only when they enter the MPC statement. Since that's not there, we have to go with 7. So that one small surprise we were expecting, upside surprise, hasn't come. It's absolutely on predictable lines. I think he's trying very hard to say that, he's not going to cut anytime soon. If I remember right, the word inflation figures in the first paragraph or the second paragraph where he talks about inflation probably a dozen times. I lost count. But nevertheless, I took a quick poll from the market. People are expecting the first cut in October, and no one has changed their mind. I can tell you how flat the policy is from the way the 10-year moved. The 10-year was at 7.110 before the speech began. It went to 7.11 and remained there. That's how the market has taken it. So entirely on expected lines. Even the inflation figure, although there's some changes in the quarterly mix, the overall inflation forecast for the current year remains the same. I think the only surprise element was that paper that they're going to circulate on LCR, that is the liquidity requirements of bank, how much they have to keep as liquid cash, in high quality government bonds. There is a paper that's going to be circulated. We can see if there'll be any changes, but it looks like it'll only be tinkering. But on that note, let me toss it to the biggest banker who is with us, Mr. C.S. Sethi, of the Managing Director of State Bank of India, is with us. Mr. Sethi, that was the only thing which was a bit of a surprise, the LCR paper to be circulated. Are you expecting any changes? That and any other comments on the policy?
Thank you, Lata. I think, as you mentioned, is broadly on the expected lines. A couple of things, of course, which I would like to borrow from the governor's speech itself, is that the liquidity management being nimble and flexible. I think that we could witness in the last few weeks that the liquidity is not constrained in the system, and whenever liquidity is excess, I think the absorption was done, and when the shortfall is noticed, I think injection was done. So to that extent, I think what governor has assured us in terms of being nimble and flexible is reassuring. On the LCR front, I think the banking currently is 24/7, with the mobile banking adoption and large-scale adoption by the UPI in India also is 24/7 today, which means that the utilization of the banking facilities and withdrawal of money, while it is very unusual case, but it's a fact that the liquidity management in the banks has become more complex. And we also have been talking to the regulator informally that there is a need for looking at the LCR framework. We will await the guidelines and see what is coming in there. But I think the concern of the regulator is that probably there could be a little more buffers to be maintained. The large banks like SBI have substantial liquidity buffers over the minimum regulatory LCR requirement of 100%. So while it may be true for the large banks, I think in the system level, there's a need for maintaining the adequate LCR. Probably that is the reason why the RBI is contemplating to relook at the framework. So let's wait for the draft guidelines and see what is coming in there.
Okay. I would assume that it won't be anything dramatic. These are largely Basel norms, the liquidity. Mr. Sethi, just one more word. He seemed a little confident on the capex taking over, the private capex cycle. Of course, government capex is doing fine. What's your own sense now that we know that for the moment policy rates are not changing? First of all, do you all expect further transmission? Because he seems to be betting on that. Further hikes are possible in the deposit rate. And secondly, capex cycle.
So I'll first address the capex cycle. We see that I fully agree that the private capex cycle is much more broad-based now. While we had the initial capex commitments coming mainly from renewables and roads, the capex cycle is private capex cycle particularly is broad-based. We see the improved utilization of our working capital facilities, and which indicates the capacity utilizations have gone up, which again in his speech Governor has mentioned. Again, I said the capex commitments from the private sector are coming across the sectors, both in terms of the brownfield expansions as well as the new greenfield commitments what they're announcing. I think I fully agree with that. That the private capital cycle seems to be moving in the right direction.
Okay, well, for the markets, it's absolutely sanguine in terms of a reaction. In fact, you'd probably want to say that it's a tad bit positive considering that the mid-caps have moved up. So the mid-cap index is up around 231 odd points post the policy. We have the bank nifty, which is marginally higher by around 88 odd points. I wanted to get your thoughts in. It sounded as though the RBI was much more sanguine about inflation as compared to earlier.
Yes, I think one, I would say that the overall policy is absolutely status quo, in line with expectations, no surprises really. And it's a fairly balanced tone. If you just look at what's happening globally, US Treasury yields are higher, crude oil prices have moved up $10 from the last policy to now, dollar index is higher, rupee is weaker. If you just look at all of this, clearly the risks are increasing. And yet the governor did sound fairly sanguine and balanced about, inflation. At the same time, I think what we need to keep in mind is they seem to be very comfortable from the growth point of view. And like Lata also mentioned, we were expecting there was some probability that a 7.4% as indicated in the bulletin could have been revised up as GDP growth, but that too hasn't been revised. But we clearly know there's an indication of an upside that they are seeing on growth front after the bulletin data was out. So I think all this is clearly wherein it gives them fair amount of room to wait and watch and let determine eventually. There are fair amount of risks on the food inflation side. And that is the reason there seems very limited room for RBI to act in the term. So they will be really looking very cautiously on most of the inflation-linked data. And of course, the global case. And that's when they can consider change, but that doesn't really happen in H1 at all.
Well, Kaushik, what did you make of the policy, reading? It was as expected, but, no revision in that growth forecast that everyone's been talking about, Kaushik.
I think it's a very prudent move not to hike the growth forecast too much, because 7% is quite a good number for FY25. Remember that the more FY gets revised up, the base effect becomes more challenging. So to that extent, getting a 7% growth number and not revising it higher, obviously that's a very prudent move, because there are lots of risks on the which will lower growth expectations going forward. It's not just what growth numbers you're getting at this point of time. What is important for certain is 2 quarters or 3 quarters down the line, how growth will look like. And there is a bit of uncertainty. So 10% is a good number to work with in FY25. The other surprising fact was, despite Governor talking a lot about inflation risk, if you see 3 quarters out of the 4 quarters, inflation has been revised downward. And April, June, there could be heat waves and all, but they have revised both the inflation forecast from 5 to 4.9. Even July, September from 4 to 3.8. And more importantly, January, March of 25, from 4.7, they have revised it down to 4.5. So obviously, that's a bit of surprise. If you are hawkish on inflation, then they should not have touched the inflation forecast. Whatever was there was okay, and there was no need for tweaking at this point of time. So that also comes to surprise. But the one thing which obviously is not mentioned, but that will play on the policymakers' mind, RBI will not talk about it openly is what happens with the Fed interest rate cycle. So if the US Federal Reserve is delaying their rate cuts, or if they are not going to cut at all in this year, like Neil Kashkari mentioned yesterday, then obviously RBI's hands will be also tied of not providing any monetary easing. Now, RBI will not come out and say that it would kind of depend, the decision would depend directly on the Fed. Probably it doesn't depend directly on the Fed, but to a large extent, what the Fed does and how they, kind of guide the market will have repercussion for RBI policy as well. So that is something which we need to look out for when the Fed will start cutting rates and how much they cut this year versus next year, which will also determine RBI's rate cut actions going forward.
Okay, got that, Kaushik. Let me get to the bond guys now. Shobit, after listening to the government, any change in your expectation of when the first rate cut will be?
Tata, I think the policy, as we've all just said, it was exactly on expected lines, no surprises. Given that even though we would not want to admit, but everybody looks up to what the Fed does. And if the Fed is going to perhaps start the easing cycle with the first rate cut in June, my own guess would be that perhaps RBI could consider an August cut if inflation moves in line as per expectations in the next few prints. However, I think focus at this stage for the market is policy is behind. It's more about the auction today. We have the first multiple price auction of the 10-year benchmark. Large auction, 38,000 crores total, 20,000 crores is the new 10-year benchmark. So I think the market is far more focused today on what the cut likely to be on the benchmark today, because that would be what market would be looking for from RBI from a signaling point of view. Because as you have said, yields have hardly budged because this large auction is pending and entire market is focused towards what kind of cutoff are we likely to see in the auction today.
Fair point. Well, same question to you actually, Sandeep. Any change in terms of rate cut expectation? The majority I got was August to October, but more leaning towards October.
Absolutely. I would echo what Shobit just mentioned. I think a large part of RBI decision making on when the first rate cut would happen would still be linked to when the Fed cuts the first time. And frankly speaking, it's very data dependent, be it India, be it US. And suddenly, it's very difficult to pinpoint whether it's going to be August, whether it's going to be October, or it could even be if data keeps on coming stronger. So we don't really have want to pinpoint when the rate cuts would be ourselves and how we see the markets. We really don't see too many risks of yields rising up because certainly rate hikes are off the table. And as a positioning part, then we prefer to be long, and we are not trying to probably look at the path dependency, but we do know that the next move is lower for the yields.
Well, we quickly, Upasna, a word from you. The monetary policy out, and the FY26 GDP projection is 7%. That is a flat growth is what RBI is expecting from the 7% again in FY25. And in FY26, the quarterly growth rates are seen in the range of 6.7 to 7.4%. We'll get you the CPI as well in just a bit. But Upasna, what did you make of this number?
I think RBI is clearly not accounting for the global slowdown, which may be delayed for sure, but it will be coming about in probably a couple of quarters. And that is where my fear is that RBI will be missing the target of even 7% for this year and even for next year as well. We are at 6.6% for this year, and the next year we are at 6.5%. So we do see 40 to 50 basis of a downgrade to RBI's estimates, largely because I do not expect the stability in global growth to be maintained through the course of next 2 years. I think we will be seeing a reasonable amount of slowdown. And talking about FY26 inflation, I think they're expecting 4.1% in the MPR, as you mentioned. So 4.1% is something which is achievable. We too are at 4.2% inflation for next year. which also suggests that there will be room created for rate easing in the second half of the year. So if all goes well, growth may have to be revised down, while inflation approaching towards 4% average, 4.1%, is something which further probably validates the case that rate easing is in the offing, just that it may be delayed depending on global and domestic parameters that we have to look at.
Okay, thank you very much. Our entire set of guests, Mr. Sethi, Shobit, Sandeep, Upasna, Kaushik, for reading the fine print and telling us how you expect things to pan out from here on. It is, of course, one of the most unexpected lines policy. Even the minor higher expectation of growth has not been acceded to by the governor. He is stuck to the knitting of 7%. And that's, I think, a very wise thing to do when you have an election backdrop. It's not that this election is going to throw up much surprises, but considering that it's a lame duck government, the governor should not ruffle feathers. So he's been as even-toned as he could be, and perhaps as he was largely expected to be. This LCR paper is just going to be something that's going to be a discussion paper, and it will not be much tweaking. It is LCR is just the liquidity coverage ratio, the amount of money that any bank has to keep as a percentage of its deposits as easily liquefiable cash. That's the meaning of LCR. It actually aligns with the SLR. So it's about 20%, give or take. The LCR tends to be a little lower than the SLR, but that's unlikely to change things much. So it's really, as expected, a BAU policy, business as usual policy. But we will have to see what comes out of the press conference. There are going to be questions, of course, which Ritu will ask the governor, as will other reporters, on why there have been such a series of actions on the NBFC companies. What has the governor and the RBI thought through in terms of currency derivatives and the underlying required. So the press conference is always going to be the most important and interesting in the Reserve Bank's monetary policy. This is only Act 1, which has ended with flat markets. Market is at 7.1 before the policy began. I mean, the bond yields. It is 7.1 right now. So much for the impact of the policy. Ritu, Ekta, thank you very much. And of course, I will be listening to you at the press conference. That's it on this Act 1 of the monetary policy. At 12, it will be Act 2.
तो मेरे को जैकेट पहनना पड़ेगा।
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay. It's policy day and things have gone as planned. Markets are absolutely quiet, flat in fact. The mid-cap index continues with its rally. The mid-cap index is up nearly 0.5%. And on the gaining side, you've got real estate, PSU banks. I'm not too sure it's because of their interest sensitives or just because they had momentum going for them, which is why they're higher. And on the way down, it's IT on the back foot today.
So, Reema, I think this is probably one of the biggest non-event policies that we've had. It really was a non-event because we didn't get anything new.
Lata's first editorial word was, it's a flat policy, right? That was the word, when we asked her, what's your editorial take?
Yeah, because no change in rates, no change in stance. In terms of commentary also, nothing which really the market's reading too much into as too hawkish or too dovish. So pretty much it is a no change policy indeed. In fact, I thought, for me, the one very interesting statement that the RBI governor made was about how RBI is going to be working together with a lot of the regulated entities, where he spoke about the need for the highest standards of corporate governance when it comes to banks and NBFCs. That was telling you, probably sort of, addressing a lot of the talk that's been doing the rounds ever since we've seen heightened RBI action on a bunch of players on the NBFC and the fintech side as well. So we'll talk more about the policy as we go forward for the market. Today, the difference is there's one thing which is the same, which is the continuation of trends on banking. And HDFC Bank is up and away once again. Perhaps it's the excitement continuing on maybe if there is sort of a weightage increase on the MSCI indices, though we know that HDFC Bank is missing the cut by exactly 5 basis points if you go by the math. But I think there's still a lot of chatter about whether, MSCI will kind of make an exception or not. So perhaps it's that. Perhaps it's just buying that's finally started on this one. The update was good and there's continued buying, second day running on HDFC Bank. So that's one important trend. The other important trend for the market is that today mid-caps have come back. So again, you're seeing a screen where the mid-cap index, the small-cap index, these are outperforming the large caps. So mid-caps took a bit of a breather yesterday. But again, the attention and focus is back on the broader market. So that's how it's playing out.
And one more thing, this week what we've seen is that India has outperformed the global markets. If you remember till last week, we were saying that US has had a fantastic, runaway rally. Most of the indices there are up 10, 8, 10, 12, 15%. But India was flat year to date. But this week, you've got the S&P 500 down 2%, the Dow down 3%, while the Nifty is up 0.8%. So India has outperformed the US markets quite considerably this week. And the mid-cap index is up 4% on record right now, at least so far this week. So that's an important element because that, we weren't mapping the US, up moves over the last couple of weeks. But today, this week at least, we've outperformed.
Absolutely. And, before we get to our guests, and we'll have lots of experts lined up for you on the show in just a bit. Before we get to that, just to talk about the movers and shakers in the broader markets, because we're telling you that it is really the mid-cap market where the action is. Look at some of the names, real estate players, Godrej Property, Oberoi Realty. These are names that are popping up on the positive side of the screen. Then you have some newsmakers. You have Macrotech developers, of course, came out with the quarterly update. So again, on the real estate side, Voltas is reacting to a good brokerage report that came in. So lots of newsmakers, lots of stocks that are moving up on decent price and volume action as well. Well, let's carry on and start getting you some of that promised perspective on the market. We were speaking to a lot of market veterans yesterday at the CNBC-TV18 India Exchange. Manish Chokhani of Enam Holdings said that consumer discretionary goods will be his one big theme going forward. He's also saying that as the government privatizes effectively to the private sector, privatization beneficiaries could become pretty big in the future. Listen in.
When you get richer, you don't buy FMCG goods, you buy consumer discretionary. So you spend more money on improving your house, you'll spend a lot more on property, you'll spend on travel, you'll buy a better car, you'll do all your home improvement stuff, you'll go out to eat. So consumer discretionary is one very, very, very big play. Housing, of course,
so you start with that, but do you think it will never trickle down?
No, it will obviously, because each time when you build a home, there are 5 people who are supplying and 10 people who are servicing you. And India has this unique pyramid of that 2% Australians, 18% Filipinos,